In the last video, we learned how investing actually works and why your money should be out there working for you. But now it's time to take the next step, turning that knowledge into action. This is how you build your first investment portfolio from scratch. You'll learn how to choose what to invest in, how much of each type, and how to make your portfolio grow, even if you're starting with just pocket change. And stick around until the end, because I'll show you the exact beginner portfolio setup that even Warren Buffett himself recommends. So, what is a portfolio? In simple terms, it's your collection of investments. If you own a few stocks, that's a portfolio. If you've got some bonds, a bit of crypto, and some money sitting in a savings account, that's a portfolio too. But here's the secret. It's not just what you own, it's how those things work together. Think of it like a sports team. You've got your attackers, that's your growth assets like stocks. They score the big points, but can sometimes miss. You've got your defenders, that's your bonds and cash. They don't score much, but they keep you from losing big when the market goes nuts. And maybe even a few wild cards. Things like crypto, gold, or alternative assets. They may be risky, but sometimes they win big even when everyone else loses. The goal here isn't to pick the single best player. It's to build a balanced team that performs under any condition. Bull market, bear market, or total chaos. Next, we're going to break down exactly how to build that team, step by step. Before you invest a single dollar, you need to ask, what am I investing for? Because your goal decides everything else. Your risk, your time horizon, and your strategy. Let's say you're saving for a car or a house in 3 to 5 years. You can't afford to take huge risks. That's short term. But if you're in your 20s and you're investing for financial freedom at 50, you've got 30 years to ride the waves. That's long term, and time is your biggest advantage. Here's a rule of thumb. The longer your timeline, the more risk you can take, and the more aggressive your portfolio can be. Now, risk tolerance is personal. Some people can watch their portfolio drop 20% and shrug. Others panic if they lose $20. To find your comfort zone, ask yourself, how would I feel if the market dropped 30% tomorrow? Would I buy more, hold steady, or sell everything? If you buy more, you're comfortable with risk. If you'd sell, you need to keep your portfolio safer. There's no right or wrong, just knowing yourself. Once you know your risk level, the next step is to decide how much goes into each type of investment. Alrighty, here's where your portfolio starts to take shape. Asset allocation means deciding what percentage of your money goes into different types of assets. Here's the trade-off you need to understand. Stocks carry high risk with high reward. Bonds carry low risk and provide steady income. Cash is safe but loses to inflation. Real estate and alternatives can diversify, but may be harder to access. Now, here are some examples of portfolios based on risk level. A conservative portfolio of low risk has 40% stocks, 50% bonds, and 10% cash. A balanced or medium risk portfolio has 60% stocks, 30% bonds, and 10% cash or alternatives. A very aggressive or high-risk portfolio would have 80 to 90% stocks and only 10 to 20% bonds or cash. And here's a famous one. Warren Buffett's advice to his own family is to put 90% of your money in a low-cost S&P 500 index fund and 10% in short-term government bonds. Why? Because simplicity works. Most people lose money not because of bad investments, but because they overthink and constantly change their plan. Next, let's make this real. How do you actually buy these investments? Here's where theory meets reality. Once you've chosen your allocation, it's time to pick your investments. You've got two main routes. Number one, DIY with ETFs or index funds. These are bundles of hundreds of companies, so you're instantly diversified. For example, Vanguard's S&P 500 ETF has top US companies in its portfolio. The Vanguard ASX 200 ETF has top Australian companies in its portfolio. The Vanguard Bond ETF covers bond market exposure. Then number 2, a managed portfolio or robo-advisor. Platforms like Raise, Spaceship, or InvestSmart automatically build and rebalance your portfolio based on your goals. If you want control, you must go with the DIY option. If you want simplicity, go the managed option. And no, you don't need thousands. You can start with as little as $10 or $20. The key here is consistency, not size. Now let's talk about the secret weapon of every great investor, the power of discipline. Here's the truth. Building your portfolio is the easy part. Keeping it growing, that's where most people fail. So here's your maintenance plan. Number 1, keep investing regularly. This is called dollar cost averaging. It means investing a fixed amount every month, rain, hail, or recession. When prices are high, you buy less. When prices are low, you buy more. It averages out and beats emotional timing. Number 2, rebalance once a year. If stocks soar and your 70-30 portfolio becomes 80-20, sell a little stock and top up bonds to get back to 70-30. It's like trimming a tree so it grows straight. Number 3, don't panic when markets crash. History shows markets always recover. If you zoom out, every crash looks like a small dip on a long upward line. In other words, don't get emotional. The market rewards the patient, not the perfect. Next, I'll show you exactly how your first $1,000 could grow over time and what that means for your future. Let's make this real. Say you start with $1,000 and invest $100 per month in a simple portfolio. Say it's $700 in a broad market ETF, $200 in a bond ETF, and $100 in cash or savings buffer. At an average 7% return per year, after 30 years, you'd have over $120,000. Double that monthly amount to $200, and you're at $240,000. That's not luck, that's compound growth. Interest on top of interest, growth feeding growth. Einstein called it the 8th wonder of the world, and the sooner you start, the more powerful it becomes. So what's stopping you from starting today? So here's your action step. Open a brokerage account or app. Decide your percentages and invest your first $10 or $100. Don't wait until you supposedly know everything. Every successful investor started exactly where you are right now. A little bit curious, a little bit nervous, but determined. You don't need to be rich to start investing. You need to start investing to become rich. If you liked what you've seen, remember to hit that subscribe button and keep coming back for more of these tips and lessons.